So here we're going to be working on Karson and Reilly. And this one is particularly interesting because the acquisition happened in the middle of the year. And so the parent has the right to the revenues and expenses of the subsidiary only after the day of acquisition. So we're going to have to take part year revenue, part year expenses for this. So they give us some data and they want us to then indicate the consolidated balances for these 6 accounts. So let's start with sales. The parent is Karson, so sales would be all of the $800,000, but only half of Reilly's because if we didn't own it the first half of the year. So we need to take out half of the sales. So consolidated sales will be $1,050,000. Notice that the brackets mean credit and the positive numbers are debits. Okay, so that's sales. What about expenses? We have 2 kinds of expenses: cost of goods sold and operating expenses. So we're going to take out half of those for the subsidiary. Okay, so the consolidated expenses is going to be those 2 columns added together. So consolidated expenses. Oh, wait a minute now. We've got to expense the fair value over book value. So let's take a look at that. It says here that on the date of acquisitions, the assets and liabilities had book values equal to their fair value, except for one, which was trademarks, which were undervalued by $150,000. So this trademark here, this $200,000 would be bumped up by $150,000 over 5-year life. So that would be $150,000 divided by 5-year times 0.5 half a year, so $15,000. So we're going to have amortization of trademark. All right, so the total expenses be cost of goods sold, operating, and that amortization, so 805. So here is number 1 and there is number 2. Now, non-controlling interest in subsidiaries net income. All right, let's make some space for that. So what does that mean? Okay, so we have the subsidiaries net income is sales minus expenses adjusted for these things. So sales less sales taken out, expenses less expenses taken out, expenses less expenses taken out, plus that additional expense. So the subsidiary's net income after all these adjustments that belongs in the consolidated activity is $45,000. So the NCI share is 20% of that, or $9,000. So that's number 3. Now, consolidated net income would be the consolidated sales less total expenses. So consolidated would be consolidated sales less consolidated expenses. We would back out the NCI share. And so the portion of net income attributable to the parent is the part that's after the back out. So they're asking for this number when they ask about consolidated net income. All right, so now they want to know what will be the consolidated trademark. Okay, so let's go on down here to trademarks. So we have the book value here and a book value here. We would be adding 150 and subtracting that 15,000 amortization, right? So the consolidated is going to look like that. Now, doing that last one, number 6, figuring out goodwill, we need the book value at the date of acquisition in order to solve for the fair value over the book value and then allocate that to everything with the remainder going to goodwill. So the book value at the beginning of the year, common stock, additional paid-in capital, and beginning retained earnings. And to that we have to add half of the net income. Net income. 25 and half of dividends. Where are dividends here? Aha! So all right, so beginning book value at the day of acquisition, which is mid-year, is the $1,450,000. This is before there's any allocation to a new asset, which would then subsequently be amortized. So as of the day of acquisition, there's no amortization. It's only subsequent to acquisition do we start amortizing the fair value over the book value. So we don't have that here in this beginning book value calculation. All right, so let's get the fair value. They pay cash here of $1,330,000. They tell us that the fair value of the sometimes the value of the non-controlling interest share is different once the parent starts buying the shares in the market. It distorts the price of the remaining shares because, of course, you just introduced a lot of demand for the shares. Okay, so they give us the $1,700,000, they give us the $1,330,000, so non-controlling interest is the difference. Okay, book value at acquisition. We just calculated that. Guess we don't have to keep it in debits and credits. And then the trademark they said was undervalued by $150,000. All right. So, and we can put some differences in here. Maybe we should. Okay. And so of the $250,000, $150,000 is going to trademark, so the rest is going to goodwill. And that is your number 6 there. Okay, ready for the next.